IDR functionality of the toolkit. DR and IDR functionality of the toolkit. So since we're working with just that, let's go ahead and turn everything else. Hey guys, I'm Jenks from the trading floor, and I'm excited to share with you some recent updates to our free SMC Toolkit indicator. Let's load it up. In TradingView, pull up the Indicators tab and type in TTF SMC Toolkit and click on the star to add it to your favorites, then click on the name of the indicator to add it to your chart. In this update, we made some quality of life improvements to the DR and IDR functionality of the toolkit, so since we're working with just that, let's go ahead and turn everything else off. The midnight and 8:30 a.m. lines, and the two sets of fractals. First thing you may notice as we're scrolling by and turning off the other features is we've added toggles to each of the DR functions. You no longer have to drop the opacity to 0 to turn off one part of DR and IDR, you just have to click on the box. Next up, we renamed regular, after, and overnight, or RDR, ADR, and ODR, to New York, Tokyo, and London respectively. We felt this made it a bit easier and much more accessible to people who are newer to the concept overall. Now, I want to skip this part here for a bit and scroll down to this, the closing price. It's exactly what you think it is. Just as we had the DR opening price line, now we also have the DR closing price line. Now you can easily use the toolkit to find the daily levels provided by each DR session's closing price. Now coming back up to here where we have the days marked out with toggles. This is a function that was highly requested in our community, so we wanted to get it implemented as soon as possible. Clicking on any of the days of the week here will extend the DR lines for that day's New York session. Many traders who start trading DR quickly realize that DR levels from earlier in the week or even the week before very often act as support and resistance. Price respects these levels. This DR extension functionality is here to help you backtest what works best for you with the asset that you trade. So whether you like extending yesterday's DR levels no matter what day of the week yesterday is, or you like picking one day out of the week to drag out till the following week, the toolkit will now draw those lines for you. If there's any other updates to the indicator that you'd like to see, let us know in the comments down below.
Hi, I'm Roxy. Welcome to the Trading Floor's Futures Trading course. In this comprehensive course, I'll provide you with a thorough understanding of futures trading. You will learn essential concepts like what are futures, how and where to trade them, risk management techniques, and the trading floor strategies in the futures market. Later in the course, I'll show you how to set up a demo account and how to take trades. By the end of this course, you'll know better if futures market is a good fit for you and how to trade futures. Let's get started with Module 1, Introduction to Futures Trading. Welcome to the Trading Floor's Futures Trading course, Module 1, An Introduction to Futures Trading. In this module, we will explore the history of futures, unique characteristics, and the diverse group of market participants that drive this dynamic and ever-evolving market. History and development of futures trading. Futures trading has a rich history that dates back centuries. It finds its roots in ancient civilizations where farmers and merchants engaged in forward contracts to protect themselves against price fluctuations of their crops and goods. However, the formal development of modern futures trading began in the 19th century with the establishment of the commodity exchanges, such as the Chicago Board of Trade, CBOT or CBOT, in 1848. These exchanges provided a centralized platform for standardized futures contracts, laying the foundation for the futures market we know today. Since then, Futures trading has expanded well beyond its agricultural origins. It now encompasses a wide range of asset classes, including financial instruments, energy products, metals, currencies, and much more. The advent of electronic trading platforms has further democratized access to these markets, enabling traders from around the world to actively participate. Key differences between futures and other instruments. Futures trading offers distinct characteristics that set it apart from other financial instruments, such as its contractual nature and that it's exchange traded. Let's dive into these differences. Its contractual nature. Futures contracts are standardized agreements that obligate both the buyer and the seller to execute a transaction for a specific quantity of an underlying asset at a predetermined price and date in the future. This standardized structure provides transparency and efficiency in trading. Futures are exchange traded. Unlike some other financial instruments, futures contracts are exchange traded. This means they are bought and sold on regulated exchanges, ensuring transparent price discovery and fair execution. I'll later on describe how this affects things like spread and slippage and some of the benefits of futures being traded on a centralized exchange. Another example, leverage and margin. One of the most notable features of futures trading is the use of leverage. Traders are required to post a margin, which is only a fraction of the total contract value. This allows market participants to control a more substantial position with a relatively small upfront capital investment. While leverage can amplify profits, it also magnifies potential losses, making risk management essential. We'll go into more about risk management later on. Settlement methods. Futures contracts have different settlement methods depending on the underlying asset. Physical commodities, like agricultural products and oil, may result in actual delivery of the asset. In contrast, most financial futures, such as stock index futures, are settled in cash, where profits or losses are transferred between traders' accounts without any physical exchange. Let's discuss futures versus options. One of the critical distinctions in options trading is the concept of time decay. As options approach their expiration date, their value can erode rapidly due to time decay, also known as theta decay. This feature adds an additional layer of complexity to options trading, whereas futures don't have the issue of time decay. Another example, leverage and account size. Leverage and accessibility play an integral role in both futures and options markets. Options and smaller accounts. Options contracts allow traders to control a significant underlying asset with a smaller upfront investment. This characteristic makes options trading accessible for those with smaller trading accounts, enabling participation without expensive capital. Similarly, futures trading also caters to traders with smaller accounts. The margin requirements for futures contracts often provides higher leverage, allowing traders to manage more substantial positions with limited capital. This is where futures has a similar benefit to trading options, but again, without the issue of time decay. Now let's take a look at Forex versus futures, comparing these two. Centralized exchange versus decentralized market. Forex trading occurs in the decentralized foreign exchange market, where currencies are traded over the counter. Futures trading, on the other hand, takes place on a centralized exchange like that provided by the CME Group. Regulation and transparency. Futures exchanges are regulated entities, ensuring transparency, standardized contract specifications, and a level playing field for all participants. The Forex market lacks centralized regulation, leading to varying degrees of transparency and risk. Traders can see wildly varying spreads, commissions, and slippage on their orders in the Forex market. We'll go into the benefits of trading a regulated centralized market later on in the course. Let's discuss market participants. Who is trading futures? The futures market is a diverse arena with various types of participants, such as hedgers, speculators, banks and institutions, and retail traders. Let's look at each. Hedgers. These are individuals or businesses that use futures contracts to manage risk and protect against adverse price movements in the underlying asset. For instance, a farmer might use futures to lock in the price for their crops before harvest, safeguarding against potential price declines. Speculators. Speculative traders engage in futures trading solely and profit from price movement without any intention of taking delivery of the underlying asset. Speculators assume risk in the hope of capitalizing on favorable market trends. Banks, institutions, and hedge funds. Large institutions and corporations participate in futures trading as an integral part of their regular business operations. They may use futures contracts to manage inventory, hedge production costs, or mitigate currency exposure arising from international trade. And finally, retail traders. Thanks to the rise of online trading platforms, individual investors have gained access to futures markets. Retail traders participate in futures trading for various reasons, including diversifying their investment portfolios, generating additional income, or seeking speculative opportunities. Congratulations on completing Module 1 of the Trading Floors Futures Trading course. You now have a solid foundation in the history, characteristics, and market participants of futures trading. In Module 2, we'll explore the exciting benefits of trading futures, discover how futures offer a regulated market, tax advantages, and opportunities for traders with smaller account sizes. Module 2, Benefits of Trading Futures. In Module 1 of the Trading Floors Futures Trading course, we laid the groundwork by exploring the history, unique characteristics, and market participants of futures trading. Now, in Module 2, we'll delve into the benefits that futures trading has to offer. Let's dive into the advantages of trading futures. Advantages of trading futures in a regulated market. One of the primary advantages of futures trading is that it takes place in highly regulated markets. Regulated exchanges such as the Chicago Mercantile Exchange or CME and the Intercontinental Exchange ICE ensure transparency, fair pricing, and the smooth functioning of the markets. These exchanges have strict rules and oversight, providing traders with confidence in the integrity of their transactions. Moreover, the clearinghouse mechanism employed by futures exchanges reduces counterparty risk as the clearinghouse acts as an intermediary between buyers and sellers, guaranteeing contract performance and pricing. For you, that means less spread hikes or widening and that awful massive slippage. Precision exits and entries are much more possible and likely in a regulated market like futures. Now, for the tax benefits associated with futures trading. Futures trading offers unique tax advantages compared to other forms of trading. Profits and losses in futures trading are often taxed at a more favorable rate known as the 60/40 tax treatment. Under this tax treatment, 60% of futures gains are taxed at the lower long-term capital gains rate, while the remaining 40% is taxed as short-term capital gains, subject to an individual's ordinary income tax rate. This tax treatment can significantly reduce the overall tax liability for futures trading, making it an attractive option for tax-conscious investors. This applies to US-based traders for application of the US tax law and requirements. If you are trading outside the United States, please look into your own country's tax laws for how futures gains and losses are taxed. Ability to trade with small account size. No pattern day trading rules. Unlike certain equity markets, think the stock market, futures trading allows individuals to participate even with a smaller account size. The use of leverage in futures trading enables traders to control a larger contract value with a relatively small amount of capital. Additionally, futures trading is not subject to the pattern day trading rule, or PDT rule, which requires equity traders to maintain an account balance of at least 25,000 US dollars to regularly execute day trades. This exemption in futures trading allows traders with smaller accounts to engage in more frequent intraday trading without the capital constraints imposed by the PDT rule. So, hearing some of these benefits, you may be wondering, can I trade futures outside the United States? Absolutely. While the focus of this course is primarily on the US futures market, futures trading is a global phenomenon. Futures brokers support international traders, providing access to the US futures exchanges. Additionally, many countries have their own futures exchanges where a diverse range of commodities and financial instruments are traded. Some of the prominent international futures exchanges include the Eurex Exchange in Germany, the Tokyo Commodity Exchange in Japan, and the Multi Commodity Exchange in India. These international exchanges and access to the US futures exchanges provide a broad spectrum of trading opportunities to traders worldwide. Module 2 has highlighted the numerous advantages of trading futures. Regulated markets provide transparency and confidence, while tax benefits can enhance profitability for traders. The ability to trade with a smaller account size and exemption from pattern day trading rules open doors to a broader range of individual traders. As we move into Module 3, we'll explore various futures exchanges and the tradable assets or instruments they offer. From agricultural commodities, financial derivatives, you'll discover the diverse opportunities available in the world of futures trading.